Okay, we may now begin.
Good morning. My name is Rick Nelson, Chair of the HOC Budget Finance and Audit Committee. Welcome to our December 21st meeting. I am joined by Commissioners Fran Kelleher and Commissioner Jeffrey Merkowitz and the Acting Executive Director Kayreen Brown and a host of other staff members. The first item on the agenda is the approval of the minutes of the Budget Finance and Audit Committee of November 17th, 2021. Do I hear a motion for approval?
I move we approve the minutes of November 17th, 2021, the Finance and Audit Committee, Budget Finance and Audit Committee.
I second.
And all in favor say aye.
Aye.
Aye, it's approved unanimously. Next item is the approval of the special or the closed
Rick,
session.
can I just clarify that includes the closed session minutes as well as the open session minutes? That the motion covers both.
Okay. Then the next item will be the fiscal year 2021 first quarter budget to actual statement. And I guess we'll have the acting CFO introduce whoever's going to discuss that item.
Thank you and welcome all to the December 21st, 2021 Budget Finance and Audit Committee meeting. We have 4 items for action and discussion. The first item, which is again the fiscal year 2022 first quarter budget to actual statements, presentation of first quarter FY22 budget to actual statements will be presented by Tomi Adebo. Tomi, if you are ready.
Good morning, Commissioners. Thank you, Tim. As Tim mentioned, I will be discussing the first quarter budget to actual statements for fiscal year 22. Looking at the agency overall on page 15, attachment A. The agency ended the quarter with a net cash deficit of $333,902. The deficit resulted in a first quarter budget to actual positive variance of $1,576,709 when compared to the anticipated first quarter net cash flow deficit of $910,611. The primary causes were savings in various expense categories in the general fund, countered by slightly lower cash flow in some of our unrestricted opportunity housing properties as a result of property performance. Looking at the general fund, still on page 15, the general fund ended the quarter with a deficit of $2,572,382, which resulted in a positive variance of $1,866,750 when we compare it to the projected deficit of $4,439,132. Income in the general fund was $281,214 less than budget due to delayed commitment fee income and lower drawers on the OHRF for real estate personnel and pre-development costs, which was offset by the final receipt of the final development fee for 900 Thayer. Expenses in the general fund were $2,147,964 lower than budget, primarily as a result of lapse in salaries and benefits, coupled with savings in professional services, computer software, maintenance contract, COVID-19 expenses, and transfers to cover the capital projects. A portion of these savings are the result of timing issues, and staff does not anticipate the full savings to be realized at year end. Moving down, looking at the bond fund, the positive expense variance in the bond fund is a result of small savings in most administrative accounts in the budget. Later today, we will present an amendment rolling forward the unspent FY21 funds. If we move on to the Opportunity Housing Fund, starting on page 16, we will first look at the Development Corporation properties, attachment B. Thank you. This chart is broken into two pieces, the unrestricted and restricted properties. The properties with unrestricted net cash flow generated cash flow of $1.62 million, which is $284,000 lower than projected. In our review, we determined that the variance is often largely attributable to items such as high maintenance, bad debt, utilities, and lower tenant income. This is true with properties such as Alexander House, Montgomery Arms, Paddington, and VPC 2. If we look at the second group on this same sheet page, we will look at the properties with restricted net cash flow. This group ended the quarter with a $1 million higher cash flow than budgeted as a result of higher tenant income. The positive cash flow variance was primarily resulting from the RAD 6 due to the receipt of prior period subsidies. If we move on to page 17, looking at the first group, the properties with unrestricted net cash flow, this group generated cash flow of approximately $620,000, which is $6,000 lower than projected. Similar to the Development Corp properties, the variance is often largely attributable to higher maintenance and utilities, which was countered by higher gross rents. If we move to the second portion of this page, we will see the properties with restricted cash flow. Cash flow for this group was $175,476 lower than budgeted. When looking at the property, the variance is often attributed to lower tenant income, higher maintenance, utilities, and bad debt. If there are any questions at this time, I will be happy to address them before moving forward.
I just have a quick terminology question. So when we say bad debt, are we talking about, renters not paying their rent? Is that what that refers to, or is bad debt something else?
It is for the non-receipt of rent, and this is the entry that is made to true up the allowance for accounts that are in arrears 90 days or more.
Okay. Thank you.
Thank you.
Question I have, and had some discussion about this before. When we are planning renovations at our properties, and we know that we're going to reduce the occupancy for a period of time, I thought we had talked about trying to adjust the budget so that it reflects that, so that we wouldn't see the variances that we see in some cases. I'm not sure why that occurs.
We do, property management does amend the budgets for the anticipated increase in vacancy for renovations. Actual occupancy for the first quarter was relatively close to budget. Some of the variance we are seeing is in the actual rent charges or the subsidies received. There are times when subsidies, as Tommy mentioned, the RAD 6, we had an influx of subsidy receipts this quarter that were for prior periods. So we can have timing variances there, Commissioner Nelson, but our occupancy is actually relatively close to what it was budgeted, and the budgets do incorporate the planned vacancy to support renovations.
Okay. Are there any other questions or comments?
Nope.
All right. So if we move on to page 18, we will look at the public fund. Starting with public housing, Elizabeth House received additional RAD vacant unit subsidies for a prior period that was subsequently transferred to Elizabeth House RAD in the first quarter. There were also There was also a small amount of expenses totaling $3,424 for continued expenses at Emory Grove. Looking at the voucher program, overall, there was a surplus of approximately $962,000. The surplus was comprised of administrative surplus of $893,000, coupled with HAP revenue that exceeded HAP payments by $69,000. The HAP surplus will be restricted to the HCVP reserve, the NRP. Finally, moving on to page 20, we will look at the capital. A few properties exceeded their annual capital budget because of unplanned capital work. Not all of the properties have sufficient replacement reserves at the property to cover the overage through September. However, staff is reviewing to see if funding can be covered by other sources. These properties include the manor at Clopper Mills and the manor at Fairhill Farm. That concludes the presentation, and I will be happy to answer any questions you may have at this time.
Any questions or comments?
Oh.
All right, the next item is the, wait a minute. First quarter unaudited financial statement.
Correct. Yes.
And who's making that presentation?
Thank you, sir. So presenting the second item will be Francisco Vega, the Assistant Controller. Again, this is the fiscal year 2022 first quarter unaudited financial statements, presentation of the unaudited financial statements for the first quarter ended September 30th, 2021. Francisco, you're up.
Good morning, commissioners, and happy holidays. If we can quickly scroll to page 28, just gives you a better visual of some numbers there. Thank you. The net position increased slightly by $396,883, or about 0.2%, from fiscal year end 6/30/2021, and it's attributed primarily to the current period net income. The liquidity ratios improve due primarily to lower current liabilities within the single-family bond attributed to scheduled and early bond redemptions. In June, the current ratio was 0.98 as compared with 2.50 in September of 2021. The quick ratio also increased from 0.85 in June compared to 2.28 in September of 2021. The total assets, excluding the deferred outflows, decreased by 7.3 million, or 0.4% since June 30th, 2021. When you include deferred outflows of resources, the decrease in total assets is 8.8 million, with a corresponding decrease in total liabilities of 9.2 million, partially offset by a 0.4 million increase in net position. The decrease in total assets was largely due to a decrease in cash and cash equivalents, attributed primarily to a decrease in general fund due to the payment to the county of the fiscal year 22 self-insurance contribution, rental license fees, rental real estate taxes, and fiscal year 22 other post-employment benefits, pre-funding contribution, as well as the timing of the reimbursements of capital expenses for several properties under construction, partially offset by the receipt of proceeds from the Stewart Town home transactions. A decrease in total mortgage and construction loans receivable, mainly attributed to a decrease in the single-family bond fund due to 16 mortgage loan payoffs, as well as scheduled amortization and prepayments of principal. A decrease in net capital assets, primarily attributed to the fiscal year 22 first quarter normal depreciation of assets, and a decrease in restricted long-term investments, primarily due to single-family bond fund and driven by scheduled bond principal and interest payments, and 24 mortgage-backed securities closings. In addition, a decrease in total liabilities is mainly due to a decrease in current maturing bonds payable and undrawn mortgage proceeds payable, partially reduced by an increase in long-term debts due to new bond issuance. That would take care of the balance sheet, commissioners. If we can go to page 23 of the presentation. Scroll down some more. Perfect, thank you. Overall agency net income increased by $396,883 in the first quarter of fiscal year 22 when compared to prior year same period, which will be 9/30/20. However, excuse me, after isolating and adjusting for capital contributions and unrealized loss, excuse me, on investments, would result in adjusted net income of $1 million for 9/30/2021 compared to net loss of $4.6 million for September 30th, 2020, for a net increase of $5.6 million.
Can you help me out and refresh my memory on the 14 million capital contributions? I was having difficulty trying to figure that one out from last year.
Commissioner, excuse me, this is Eugenia. Let me go back to the previous report and I'll answer the question towards the end of the presentation, if that's okay.
Thank you.
Thank you.
Thought it was the, okay.
Go ahead, Francisco.
Okay. The overall increase of 5.6 million in the adjusted net income is largely driven by an increase in HAP revenue, dwelling rental income, and other federal, state, county grants, partially offset by an increase in maintenance cost, administration expense, and fringe benefits. If we can scroll to the next page, that would be great. Scroll down, perfect. The HAP income in FY22 is higher than FY21, mainly because of the reduced funding in the first quarter of fiscal year 21 due to the offset of excess HAP revenue as of December 31st, 2019 against the July 2020 HAP funding. The incoming portals and 2017 mainstream program contributed as well. An increase in dwelling income is mainly due to Bradley Crossing LLC, which was acquired in June of 2021. The increase from RAD 6 properties, Shady Grove Apartments LP, and Elizabeth House RAD interim property also contributed to higher rental income. The increase in state and county grants is mainly due to the county capital improvement programs and the county main grant. This increase is partially offset by maintenance expense, an increase in maintenance expense, mainly driven by an increase in the Opportunity Housing Fund expense for paint, wall coverings, appliance, equipment, flooring, carpeting, roofing, asphalt, concrete contracts, plumbing supplies, cleaning, janitorial, landscaping, and other miscellaneous contracts. An increase to administrative expense driven by an increase in salaries, fatherhood program, tuition assistance, and other operating services contract within the public fund. Cost of issuance related to Housing Production Fund, Series 2021, limited obligation bonds within the multifamily bond fund, and an increase in rental license fees within the Opportunity Housing Fund. If we can go to page 26. Great, thank you. Similarly, when revenues from operations are adjusted for HAP income and realized loss investments, the difference is 4.3 million, resulting in adjusted operating revenue of 39 million compared to 35 million during the same period last fiscal year. Additionally, When operating expenses are adjusted for HAP expenses, the increase is 4.8 million, which is indicative of actual operating expenses. Lastly, as illustrated, when certain line items are isolated and adjusted within operating revenue and operating expenses categories, a clearer picture is presented from an operations perspective. Thank you very much, Commissioners.
Are there any questions or comments on?
Commissioner, this is Eugenia Pascual again. I'd like to address your question on the 14 million capital contribution last year. That's
Okay,
coming from the Bauer Park transaction that was contributed, the proceeds to the agency from Banner Housing.
thank you.
You're welcome.
Now we're going to go to the budget amendment. Second quarter budget.
Yes. Batting number 3, Terry Fowler, our budget officer, will take us through item number 3, fiscal year 2022, second quarter budget amendment, presentation of the FY22 second quarter budget amendment.
Thank you, Tim. Good morning, Commissioners. I'm presenting the second quarter FY22 budget amendment. On page 41 of your packet, the operating budget has 2 items. Each year we budget to draw from our bonds to pay for the administrative cost of the multifamily and single-family bond programs. Tommy mentioned previously that we have cumulative savings from these draws in prior years. This budget amendment serves to roll over those funds to be used for FY22 administrative costs. So the projected draw for the multifamily will be reduced by $133,516, and the draw for the single family that is projected for FY22 will be reduced by $82,613. The net effect is that we will carry forward the savings, and so there is no change to the operating budget of the agency, and it remains balanced. On page 42 of your package, you will see adjustments for the capital budgets for the Metropolitan. We will be increasing that capital budget by $31,040 to replace a failed water heater at the property, and there are sufficient reserves to cover that cost. The second water heater at the property replacement will be incorporated into the renovation budget for the property. And for Cider Mill, we have 6 roofs in need of immediate replacement. There are sufficient reserves, and the capital budget for that property is being increased by $845,000. The total capital budget for the agency will increase from $439,141,889 to $440,017,929, a total increase of $876,040. Approval by the commission of these amendments will revise the budget to reflect an accurate plan for the use of the agency resources for the remainder of the year. And I'd be happy to address any questions you may have.
Do I hear a motion? For sending this forward?
I move that we approve the budget amendments.
I second
You're
it.
moving to send it to the full commission.
Right, sorry.
Okay. And did I
I
hear
second that.
a second? Are there,
Yes.
is there any discussion on the budget amendment? Then all in favor say aye,
Aye.
and approved unanimous.
Thank you.
Before we get to the next, let me ask a couple questions. One, which I frequently ask, among all these pluses and minuses, and as I read through all this, I don't foresee any serious issues posed so far in terms of our budget for the year. Is that the assessment of you folks who are presenting all this to us?
Very early in the year, but I'm optimistic based on where we are at this time.
Okay. The next question I have, and I'm not sure who wants to try to do this, but what do we have planned during this year that could be impacted if the Fed decides to increase interest rates 3 times?
So we have a few financing transactions that are planned for calendar year 2022. From my perspective, the Fed's adjustments to interest rate is primarily near term and doesn't necessarily impact the long-term rate, which is where we see the most benefit. However, there are other things happening in the economy. There are inflation issues that we have to deal with, and just general riskiness overall that could cause interest rates to be higher. But it is something that we're going to be monitoring closely. The short-term movement in interest rate will impact any short-term borrowings that we have or any floating rate debt that we have outstanding. But as far as the long-term 30-year, 40-year financing that are concerned, there are other things at play in the economy that will impact those more so than the short-term changes in interest rate. But again, something that we'll be monitoring closely.
But the short-term affects all of the relock.
Yeah, all of the draws on the, yeah, yes, absolutely. So those will, we'll see those changes there as those rates increase. Yes.
Okay, so I would just hope that you let us know as those rates increase and what that impact is going to be upon the.
Right, and I think we've become so accustomed to 17 basis point as a LIBOR base rate plus the spread that it's almost insignificant when there's small changes. When rates start to go significantly higher and we expect there to be gradual increases, not big shifts, then we'll see the real impact. But yes, we will be monitoring and reporting on those.
Okay, good, thank you.
Yep.
And I'd just add, when we use them for transactions, we do take a conservative rate view. So, when we do our pro formas that have the relock involved, we do put a pretty substantial cushion in there.
Okay, thanks. Next item, the uncollectible tenant account receivables.
Thank you, Terry. Item number 4, as you mentioned, uncollectible tenant receivables, that will be presented by Nilu Rizigi. Nilo, you're up.
Good morning. The agency's current policy is to provide for an allowance for bad debt on tenant receivables, which have been outstanding for over 90 days. On a quarterly basis, the staff also recommend to the Commission the write-off uncollected receivable for past tenants. The proposed write-off for the first quarter of fiscal year 2022 amounted to $17,000, a decrease of $34,000 compared to the previous year this time. This period's write-off consists of $14,000 of bad debt from the Opportunity Housing properties, which included McHome, MHLP 9, MPDU Pond Ridge, MHLP 10, State Rental Partnership, and VPC 1 Corporation, $230 from LIHTC RAD properties, and $3,000 from the 236 properties. The primary reason for the write-offs across the properties include tenants who voluntarily left their unit, passed away, purchased a home, no longer qualifies, went to a nursing home, and left due to a job transfer. After the full Commission's approval, the write-off will be processed through Yardi with the tenant detail. The next anticipated write-off will be for the second quarter of fiscal year 22, which will cover October 1st to December 30th, 2021. If you have any questions, we'll be happy to answer them. Thank you.
Is there a motion?
Move that
We're
we
sending this
accept,
forward? I'm
I-
sorry.
I move that we forward to the commission the report on uncollectible tenant accounts receivable with staff's recommendation included.
Second.
I have one question. I think I've asked it before. I'm just unclear. Part of the rationale, reasons that you give for this are people who have purchased their home. Why is it that their delinquencies don't affect their ability to purchase a home
So
in
I think
terms of credit?
they're likely to be approved.
Pardon me?
They're likely to have been approved for a home purchase, sometime before they become delinquent. It is unclear to me. It should have some impact, but they're likely to have been approved before they actually move out and stop paying. Probably something we could dig into a little bit more to see, the length of their delinquency, because if they're very delinquent and we're not reporting it, then I guess that's on us. But you're right, in a perfect world, it should have some impact, and that should be the catalyst to make them pay.
So these people are skipping and then moving to their new home.
Sounds like they get approved for the purchase, then stop paying us.
Right,
It seems we should still be able to collect though at
right.
some point on that.
And I think we are still pursuing collection efforts even after the fact. We do have a collection agency that we work with, so we still pursue collections.
Well, if it just is counterintuitive for this to occur.
Mhm.
So if we have the opportunity, I'd appreciate some look at this to see if there's something that we're missing or something we can do. The collection after they purchase the home or the attempt to collect isn't the best solution. I mean, but anyway, I'd really appreciate it if you look into this.
Sure.
Anything else from the staff?
I think this is all for the agenda, but I would just like to share with the committee, and I did with Commissioner Nelson before the meeting started, that we have closed on all the real estate transactions that were scheduled to close by year end. And that includes the 3 Willow Manor properties that were combined into a single owner entity, as well as Georgian Court and Shady Grove. So we're now poised to start the renovation of all of those properties. And the staff did a tremendous job working with the state in allocation of the tax credits with the investors, and negotiating through all their documents. And by staff, I mean staff of the real estate, mortgage finance, property management. I mean, it's everyone, and in particular, our legal department did a tremendous job keeping things on course and getting us to closure. And so I'm happy to report that those were successful closings.
I think we've said this before in some commission meetings, but I think this just points out the fact that the pandemic notwithstanding, staff continues to step up to the plate, and I think it's done a tremendous job in view of all of the obstacles that get presented to you guys. We as commissioners appreciate it. And I think the program generally benefits because of this fine work of the staff. And you deserve and have earned the next week off. So I'll make a major decision and advise you that you can have the next week off.
Appreciate that.
Any other comments? And I'm sorry, I forgot. There's some other folks who might be looking at this. That is not a comment that is unexpected.
That's your personal opinion.
Yes, the fact is that the HOC staff will in fact It's been planned, be off, and the offices will be closed Friday through the following Friday. Is that correct, Karine?
That's correct.
Okay. My comments notwithstanding. Are there any other comments from either staff or other commissioners?
No, I'd like to echo thanking the staff for really just keeping things moving ahead with all of the changes that have come down the pike from so many different directions. It is a real sign of the experience and maturity of the staff that we can have such a routine good report after what has been anything but a routine year. So
Absolutely.
thank you very much.
Yep, no, absolutely. And, you know, the work all of you are doing are helping ensure that thousands of our residents are having a happy holidays as well.
Yes.
So,
Absolutely. Thank you.
thank you.
So with that, I wish you all a very happy holiday.
Thank you, and the same to
Same to
you.
you.
Yeah.
The holidays all.
Are you adjourning the meeting?
Oh, I'm sorry. The meeting, there being no further business, the meeting is adjourned.
Thank you. Merry Christmas.
Thank you.